When you look at this chart, you've seen this chart before, and the markets are still in a position where I don't want to jump into equities. I'm not encouraged to go out and buy equities right now. And the reason is when you look at the S&P 500 forward price earnings ratio, we're like right in between fairly priced and overvalued, even at this point in the market. And if you think like an investor, or especially an institutional investor, they're really waiting for things to go on sale, and they're just not on sale yet. The blue area is attractive in this chart. The very attractive part is the green area. This is where the money managers really want to see the PE ratio go so they can buy at a discount and then write it back up. And when you think about the earnings estimates or the growth estimates, the overall consensus in the market is that we're going to have about a 1% growth. But when you take in all the weighted averages that City National Rockdale looks at, they're thinking more of a negative 3.5 to a negative 5 if we end up in a mild recession, which again is likely. So the price earnings ratio really has to come down quite a bit before the big money moves in and we start seeing a capitulation in the market. So the whole thing here is let's wait for the opportunity. That's why we've got ourselves in defensive positions with treasuries, and we're just waiting for that opportunity for the market to capitulate so we can activate these strategies, and then let's reap the rewards from them. From a fixed income performance standpoint, this year actually bodes a whole lot better than last year. You know, in here it says the performance has been consistent, and you could probably say that from 2022 and for 2023 year to date. 2022, well, it's consistently bad. 2023, we're off to a very good start from a fixed income standpoint. And when you think about the different asset categories, the chart on the right-hand side shows that the corporate and the municipal high yield tend to have higher returns than the corporate investment grade and the municipal investment grade, which is a lower rate of return. But you can also see the risk is lower on investment grade and the risk and volatility is higher on the high yield. So you really got to pick your poison when you're getting into yields and bonds as to what your risk tolerance will allow you to do and stay the course. But the good news is we've got much higher returns in bonds, and like Rocky had said, our fixed money market accounts are producing over 4.5%. And the laddered treasury portfolios are right around the same performance. So they're performing the way we want to. They're stabilizing the portfolio. So if we do have a downturn, we will be ready to act on that and really capture all we can capture on that downturn. You know, let's have a great month, Rocky, and you take care of your family, and
we'll take care of you guys. Thank you for joining us today.
yeah, this was great.